The news says the economy is recovering. Growth is back. Markets are rising. Unemployment is falling. On paper, everything looks better. But for many people, nothing feels different. Rent is still high. Groceries are still expensive. Savings are thin. And the sense of financial security remains just out of reach. So the question quietly lingers. If the economy is recovering, why doesn't it feel like it? This isn't just a matter of perception. It's a reflection of how modern economic recoveries actually work, and who they tend to benefit first. Because in today's financial system, recovery doesn't spread evenly. It moves through the economy in layers, reaching some groups quickly while bypassing others for years, sometimes indefinitely. To understand why, we need to look beneath the headlines and examine how a recovery truly begins. Most economic recoveries start in response to a crisis. When a recession hits, businesses slow down, unemployment rises, and spending contracts. To prevent a deeper collapse, governments and central banks step in with aggressive measures, lowering interest rates, increasing public spending, and injecting liquidity into the financial system. These actions are designed to stabilize the economy and restore confidence. And in many ways, they succeed. Financial markets calm down. Credit becomes easier to access. Businesses regain the ability to borrow and invest. But here's the critical detail: the first place this new money flows is not into household incomes, it flows into the financial system. Banks receive liquidity. Large corporations refinance their debt. Investors deploy capital into stocks, bonds, and real estate. As a result, asset prices often recover long before wages or employment do. Stock markets may reach new highs while many households are still struggling to pay their bills. This creates the first disconnect between the official recovery and everyday reality. This phenomenon is sometimes described as the financialization of recovery. Instead of growth being driven primarily by rising incomes and productivity, it is initially driven by rising asset values. For those who own financial assets, this can create substantial wealth. For those who rely mainly on wages, the benefits are far less immediate. Consider the timeline of a typical recovery. After the 2008 global financial crisis, major stock indices rebounded within a few years, eventually reaching record highs. Yet median household incomes in many countries took much longer to recover, and in some cases, purchasing power remained stagnant for over a decade. Similarly, following the economic shock of the COVID-19 pandemic, financial markets surged rapidly, even as many workers faced prolonged uncertainty. This pattern is not accidental. It reflects the structure of the modern economy. When central banks lower interest rates, borrowing becomes cheaper. Large corporations and financial institutions, which already have access to credit, are the first to take advantage of these conditions. They can refinance existing debt, invest in new projects, or repurchase their own shares, all of which support higher asset prices. Households, on the other hand, face a different reality. Many people cannot easily access low-cost credit, especially after a recession when lending standards are tighter. Even when they can, taking on additional debt is often risky in an uncertain job market. As a result, the transmission of recovery to everyday incomes is slow and uneven. Another key factor is the labor market. Employment statistics often improve before wages do. Companies may begin hiring again, but they tend to remain cautious, offering lower wages or relying on temporary and part-time positions. This means that while the unemployment rate may fall, the quality and stability of jobs do not always improve at the same pace. Globalization and technological change further complicate this picture. Over the past few decades, automation and international competition have placed downward pressure on wages in many sectors. Even during periods of economic expansion, productivity gains do not necessarily translate into higher incomes for workers. Instead, a larger share of the economic gains accrues to capital owners and highly skilled professionals. Housing provides another powerful example of this imbalance. Low interest rates during recoveries often fuel increases in real estate prices. While this benefits existing homeowners and investors, it creates significant barriers for first-time buyers. For many young or lower-income households, the recovery effectively raises the cost of entry into the housing market, making long-term financial stability more difficult to achieve. Inflation adds yet another layer to the story. As the economy recovers and demand increases, prices for essential goods and services can rise. When wage growth fails to keep pace with inflation, households experience a decline in real purchasing power, even if nominal incomes are increasing. This dynamic reinforces the perception that the recovery is leaving many people behind. There is also a psychological dimension to economic recovery. Financial markets respond quickly to expectations about the future, often pricing in optimism well before it materializes in the real economy. For individuals, however, financial security is based on tangible factors such as stable employment, manageable living costs, and the ability to save. When these conditions lag behind market performance, the recovery feels abstract and distant. Government policies can influence how broadly the benefits of recovery are distributed. Fiscal measures such as direct transfers, unemployment benefits, and investments in public services can help bridge the gap between financial recovery and household well-being. However, these policies are often temporary or limited in scope, while the structural forces shaping inequality persist over longer periods. It is important to recognize that economic indicators, while useful, do not capture the full complexity of lived experience. Gross domestic product measures the total value of goods and services produced, but it does not reveal how that value is distributed. Similarly, stock market indices reflect the performance of publicly traded companies, not the financial health of the average household. This divergence between aggregate indicators and individual well-being helps explain why trust in economic narratives can erode during recoveries. When people are told that the economy is improving but do not see corresponding changes in their own circumstances, skepticism naturally arises. This gap between perception and reality can have significant social and political implications, influencing everything from consumer behavior to public policy debates. The irony is that the very policies designed to stabilize the economy can inadvertently contribute to these disparities. By supporting financial markets and lowering borrowing costs, they create conditions that favor asset owners. Over time, this can lead to a widening gap between wealth and income, making subsequent recoveries even more uneven. None of this means that economic recoveries are illusory. They are real and essential for restoring growth and preventing deeper crises. However, they are also complex processes shaped by structural factors that determine who benefits and when. To visualize this, imagine the economy as a series of interconnected layers. At the top are financial markets and large institutions, which respond quickly to policy changes. Below them are corporations and businesses, which adjust their investment and hiring decisions over time. At the base are households, whose financial well-being depends on wages, job stability, and the cost of living. Recovery flows through these layers gradually, and by the time it reaches the base, much of its momentum may have dissipated. This layered transmission of recovery helps explain why inequality often increases in the aftermath of economic crises. Those positioned closer to the initial flow of capital benefit earlier and more substantially, while others must wait for the effects to filter down. In some cases, the benefits never fully reach them. The long-term implications of this pattern are significant. Persistent disparities in income and wealth can limit social mobility, reduce consumer spending, and create vulnerabilities within the broader economy. When large segments of the population do not share in the gains of recovery, overall economic resilience may be weakened. There is also a feedback loop at play. As wealth becomes more concentrated, asset prices can be driven even higher, further amplifying the advantages of those who already own them. This dynamic can make future recoveries increasingly dependent on financial markets, reinforcing the cycle of uneven distribution. Understanding these mechanisms is crucial for interpreting economic news and making informed financial decisions. It encourages a more nuanced perspective, one that recognizes the difference between headline indicators and underlying realities. So, the next time you hear that the economy is recovering, it may be worth asking a different set of questions. Who is experiencing this recovery first? How long will it take for the benefits to reach the broader population? And what structural factors might prevent that from happening? Because the story of economic recovery is not just about growth. It is about distribution, timing, and access. It is about how the architecture of the financial system shapes the lived experiences of millions of people. In the end, the most important insight may be this: a recovery is not a single event but a process, and its success cannot be measured solely by aggregate statistics. It must also be judged by whether it improves the financial security and well-being of the majority. Until that happens, the phrase economic recovery will continue to carry a quiet contradiction, one that reflects the difference between what the numbers say and what people actually feel. And perhaps the most pressing question is not whether the economy is recovering, but whether the structure of the system allows that recovery to be shared.